it's clear that there may be some zombie companies that are helped out here. But it's also clear there are going to be large numbers of good, solid companies who are otherwise at risk of going to the wall. And I think my favorite is this story of Hertz, which was on the verge of bankruptcy. And then a lot of small investors piled into the equity, into the stock. And you saw the price go up enough that they were able to announce a capital issue and keep going. I think that's a fascinating story.
Giles, good morning to you, my friend. I've never had you down as a man of understatement, but I think you just did. You said it's clear that some may go to the wall. In the United Kingdom, Charles Randall, who is the boss of the FSA, the chairman there, has said that there is a real danger that a vast amount of these business loans that have taken place could well never be paid back. In fact, bank bosses believe that half of the £18.5 billion of bounce-back loans may never be repaid as well. We've got an apocalypse in terms of small and medium-sized companies, possibly some of the bigger companies, if indeed we don't get central bank support for their paper, haven't we?
Well, that's absolutely clear. And of course, that's why Jay Powell in the US has taken the action that's just been announced. And I'm afraid it's why in the UK, where, as you say, smaller companies are in many cases in deep trouble. The Bank of England's done a lot, but it has to do more, I'm afraid.
So back to the issue. Should central banks buy paper of companies which, as Jeff said, probably wouldn't have made it before the pandemic, but because of the pandemic won't make it unless they are kept on life support for years? Surely that is the problem we've had on this side of the Atlantic, where banks have failed ignominiously for year upon year to recognise the losses from the GFC. Surely that's setting us up for a dire consequence economically, even when the pandemic is conquered in the next 10 years.
Look, I think in a way you're being too narrow. To my mind, look, we've had a decade of ultra easy monetary policy. I agree with that. But it's not just been because of bank credit. In fact, I think often bank credit has actually been quite tight and quite difficult to access. I think if we want to look for a real area for maybe not zombie companies, but for companies inappropriately financed, let's look at private equity. Look at all the money that flooded into companies like WeWork, and then their business model is shown not to be anywhere near the scale that was believed to be the case. Even Uber could be put into the same bucket. I think focusing on bank loans to smaller companies, that's something completely different. We need more of that, not less.
Giles, I want to get into how investors are digesting the news flow at the moment, because as we talk about stimulus, it feels as though many investors are eyeing that particular bucket of cash, whether it's coming from the government or from the Fed, from central banks. In terms of the news that we've had out in the last 24 hours, the jump in retail sales, so some pent-up demand clearly displayed at the stores as Americans went out of lockdown, a 17.7% spike. Also news that just a cheap steroid might be a useful treatment for COVID-19. That matched against what we're seeing, clusters now of COVID-19, a second wave around Beijing, also New Zealand that seemed to have gotten rid of its coronavirus problem. What do you make of the negatives versus the positives and what investors are doing with them?
Look, at risk of drawing a slightly unpleasant analogy, if we look back to the past when, very sadly, we had terrorist attacks, often if you get a terrorist attack coming more or less after a long period of calm, you get quite a big market adverse reaction. And then successive attacks, the markets become a bit more relaxed when they see that the sort of overall effects are more limited. And as I say, although in a way it's not a very pleasant analogy, I think that's rather the case as we look at worries about second wave. We had our big first effect on the markets when COVID first appeared. I think now, as investors look to these kind of renewed outbreaks, each time the market reaction will become more and more limited. And I think that's right, because in fact, although they're a bit worrying, these new outbreaks do by and large look relatively small. And if you look at some of the US states like Texas, where you've just had a resurgence, part of that's real, but part of it is just because their testing rate was very low and now it's going up. So net, I think the market will look through the bad news on the virus and focus more on the good news, at least for the next 2 or 3 months, of the economy rebounding.